Thank you, Madame Lagarde. The next question is for Francesco Canepa of Reuters. Francesco, please. Francesco, can you hear us? We cannot hear you. We will then go to someone else and I'll come back to you. So in the meantime, Isabella Bufacchi of Il Sole 24 Ore, please. Isabella.
Good afternoon, and thank you for taking my questions. I apologize for the video that is not on. President Lagarde, I have a first question on your financial stability toolbox. How far is the Governing Council worried about financial stability in the euro area? You made a reference to the no liquidity shortages, but you did announce the liquidity lines. So maybe you can tell us what you can do if for the financial stability. And then a second question is actually on digital currencies. I know you made so many decisions today, but EU sanctions targeted the Central Bank of Russia in an unprecedented way, and this triggered a new focus on central bank digital currencies. Can we expect that the ECB is going to accelerate the process for the digital euro? Thank you.
Thank you, President. I will try to answer your question on financial stability. Well, it's quite clear that we have seen since the beginning of the invasion, volatility, tensions, stress in financial markets. But I think that perhaps, the main point that I would like to stress is that this situation is not comparable to the one that we had 2 years ago. Liquidity has not disappeared from the markets. And despite, the situation of tensions that we have seen in certain financial and capital markets, well, liquidity, as I have said before, has not disappeared. We are closely monitoring different financial markets. We have seen a lot of volatility, for instance, in equity markets. As well, we are also looking at what's happening with corporate bonds. In terms of corporate bonds, spreads have widened, but as I said before, liquidity has not faded out. And finally, there is a very specific market that we are looking very carefully. That is the derivative market. And mainly, one part of this derivative market is the commodity derivative market. So far, in the clearing houses, we have not seen any sort of a special volatility there. All the margin calls derived from the increase in commodity prices have been honored. But we are closely monitoring the situation. And finally, in the government bond market as well, we have seen ups and downs in terms of nominal yields, but the spreads have been quite contained. So the conclusion is Russia is important in terms of energy markets, in terms of commodity prices, but in terms of the exposure of the financial sector, of the European financial sector to Russia, is not very relevant. And simultaneously, the size of the Russian economy is quite limited. It's only 2% roughly of the world economy. So the situation, perhaps the main conclusion, is that the strains and the tensions that we have seen are not comparable at all to what it happened at the beginning of the pandemic.
Yeah. And on your question concerning CBDC, you know my views on CBDCs, and you know that I have pushed that project. Fabio Panetta is working hard on that together with members in the entire Eurosystem, with a high-level task force that is working really hard on moving forward. But in a way, I'm really pleased that attention is now focused on the role that cryptos can play and the role that central bank digital currency can have when they are implemented. We have a schedule, as you know. The Governing Council decided back in October 21 to launch a 2-year investigation phase, and it is at the end of that investigation phase that the decision will definitely be made to launch the CBDC and to make it a reality. We can't go wrong with that project. I'm confident that we will move ahead, but that's going to be a decision of the Governing Council. I think it's an imperative to respond to what the Europeans expect, and I think we have to be a little bit ahead of the curve if we can on that front. So if we can accelerate the work, I hope we can accelerate the work. I will certainly support that. And I was delighted to see that in the United States, there was an executive order by President Biden to actually expect similar effort and focus and progress on CBDCs, cryptos. And I think that it will take all the goodwill of those who want to support sovereignty, who want to make sure that monetary policy can be transmitted properly using our currency will endeavour. On the issue of financial stability, I totally concur with my Vice President, De Guindos, but I will also point you to the last sentence in the first paragraph of our monetary policy statement. And I know that there's been an abuse of that, but we mean it. We will take whatever action is needed to fulfill the ECB's mandate to pursue price stability and to safeguard financial stability. So, have no doubt.
Thank you, President, Vice President. Francesco, we want to give it another try, so please ask your question. Some transmission problem today. So then I would give the next question to Klaus-Rainer Jakisch of ARD Television. Klaus-Rainer, please, for you. Klaus-Rainer, we cannot hear. I see you talking, but we cannot hear you. Until the problem is sorted out, I will then give the question to Martin Arnold of Financial Times. Martin, I hope we can hear you.
Hello, President Lagarde. Can you hear me?
Yes, indeed.
Excellent. My two questions are as follows. Firstly, with the ECB now accelerating the withdrawal of its monetary policy stimulus, do you think the onus must be on fiscal policy to support the Eurozone economy from the impact of the shock from the Russian invasion of Ukraine? And the second question is, what would the ECB's reaction be if the Ukraine Central Bank was to request a swap line from the ECB? Thank you very much.
Well, thank you for your question. I'll start with the second one. We are actually exploring, together with other European authorities, and in particular with the Commission, how we can deploy tools in order to support the Ukrainian people and the Ukrainian authorities. So clearly looking at how support can be structured, whether under existing product, you mentioned swap line, repo line, or under other products, because clearly we have conditions under which we can extend swap lines and repo lines. And if those conditions are not satisfied, we need to find alternative ways of providing support. And that is what we're doing, both in relation to the authorities, but also in relation to the people of Ukraine, who, when they become refugees, unfortunately pass the border, need to access alternative currencies to theirs, which, as a result of the decision that was made, is not convertible as it used to be. So we are really working hard. I hope that in the next few days we'll be able to provide tools and means to extend support to both the people and to the authorities, together with the Commission, and sometimes, in some cases, national authorities within the Eurosystem. On your other point, let me just make that clear once again. The decisions that we are making today are the logical continuation of our December decisions, of our February communication, and we are on this path which is data determined and which is also delivering on our mandate, which is that of price stability. So we're not talking about accelerating, we're not talking about tightening, we're talking about normalizing, simply because we acknowledge the fact that in the present environment, which is that of high inflation and not low inflation, as it was in the past, the support that net asset purchases can give to policy rates is getting close to conclusion, and therefore requires that we decelerate the pace of purchases, consider the fact in Q3, or at the end of Q2 rather, to decide whether, depending on the data that we get, we effectively conclude net asset purchases, the principle of which was agreed today. Thank you.
Thank you, Madame Lagarde. I see that now Balazs Korani from Reuters is connected, so perhaps you can connect Balazs for you, please.
Trying my best. Do you hear me?
Yes.
Great. Apologies for this technical issue. President Lagarde, in your press conference, you mentioned that in the discussion there were various options being discussed, or at least advocated by governing council members. Could you tell us a bit more? Were there people who suggested no end date, or what were the options that governing council members advocated? The other question I have is sort of this longer, broader question about inflation. I think it's clear that even after the war, there's no returning to the pre-war normal. Governments are spending more on defense, commodity prices are likely to stay higher than before, and the green transition is going to be accelerated. Now, all of these factors are long-term inflationary, I believe. Is this something that you discussed in the Governing Council, and how were these factors taken into account in your projections?
On your first question, I'm sure that some of you will really enjoy picking up the phone and trying to question who said what, when, and on one topic. Let me just be very clear on that. There were some members who thought that, given the uncertainty that we have, we should be uncertain as well and do nothing. There were other members who thought that, despite the uncertainty, we should move ahead and not have any conditionalities. Okay, so you have both ends of the spectrum. And I think that the proposal that was debated and supported by the executive board and presented by Philip Lane, the chief economist, was this balanced approach of taking into account the baseline produced by staff, acknowledging the inflation numbers that we are seeing now and the inflation outlook that we have for the medium term, to propose a path that reduces net asset purchases, brings us to concluding the net asset purchases under the conditions that data actually confirm the outlook that we are seeing now and that we are seeing in the scenarios produced by staff. So that's what the package was, and it is a package. It's a package of a determination, conditionalities, the removal of the shortly before, which has not been replaced by shortly after, but by sometimes after, so as to delink, and maximum agility and flexibility, as you will have seen in the description of the various instruments, and that thing that was published in the press release. And I'm here referring clearly to flexibility that we give ourselves under the PEP reinvestment policy. Speaking of reinvestment, let's not forget that we have a I just want to, maybe I'll have the right exact number that I can give you in terms of reinvestment policy under the APP. I thought I had that somewhere. Anyhow, we have more than 5 trillion euros worth of assets that we will be reinvesting over the course of time. So it's not as if we were, tightening monetary policy going forward. We are normalizing monetary policy with the caveats that I have just outlined. Now, obviously, when we look at the medium-term inflation outlook, we also do a risk analysis. And while we are clearly of the view that given the drivers behind inflation, energy predominantly for the moment, supply bottlenecks, food prices increases, and a broader increase of prices in general, which is coming from energy predominantly and translates throughout all the items. Clearly, risks to inflation is to the upside, particularly in the short term, but possibly also in the medium term, but not exclusively, because risk to inflation could also be to the downside. So you mentioned some of the investment projects, some of the fiscal spending that will probably take place over the course of the next few years, and that will certainly continue to push prices up. If anything, it's a good reason that we should stick to our mandate of price stability and of bringing medium-term inflation outlook to our target of 2%. Thank you.
Thank you, Madame Lagarde. And the next question goes to Mark Scheuers of Börsenzeitung. Mark, please. You are muted, Mark, still. We can't hear you. No. No, sorry. I will then go to Eric Albert of Le Monde. Eric, please.
Good afternoon. I hope you can hear me.
Yes.
Thank you very much for taking my question. I got a couple of questions. One on the fiscal side. As we are talking now, the EU leaders meet in Versailles. How much can you expand a bit on what you expect from the fiscal side, especially from the EU side? Would you like to see some common borrowing again? And on the inflation, mostly on the energy shock, before the war, there was already a pretty big energy shock, but some hope that maybe it was stabilizing. There's absolutely no hope now that it will stabilize in the short term. How long-lasting do you believe this energy shock might be? It looks like, if Europe turns its back to Russian gas and oil, there will be a very long-lasting shock, and it will be for the foreseeable future. What do you say to that?
Well, thank you for your two questions. On the first one, which relates to the fiscal effort, we clearly point out in the monetary policy statement that fiscal support will continue to be critically important. What form it takes, whether it is a national fiscal effort with a good focus, with target on those that are most affected by the current crisis, particularly energy crisis, or whether it takes a European-wide format, is something that obviously the leaders will have to decide, and I'm sure that they are, as we speak or as they meet, be addressing those questions. I think we have a long-standing record of arguing for some fiscal facility at the European-wide level in order to respond to shocks. We are clearly facing a major shock, whether it is just the pure war or whether it is the energy prices. But this fiscal facility that we've advocated, we stand by and do believe that it can be extremely helpful, particularly in order to move Europe to a more integrated basis. On the, when will energy prices stabilize? in our assumption and in the scenarios that have been developed, there is the assumption that oil and gas and energy prices in general will, throughout the projection exercise, stabilize, certainly not in the short term. What we are not seeing, and that takes me a little bit away from energy prices, but it's clearly related to how long it takes to stabilize. But what we're not seeing so far, and we are very, very much scrutinizing the numbers, is wage pressure. You know, when we look at the numbers for the fourth quarter of 21, the wage increases have actually been lower than the average of 2020. So we are trying to get as much intelligence and as much understanding of how and where wage pressures are going to come from, because it will have an impact on the underlying inflation that is integrated in our medium-term outlook and in our forward guidance. Thank you.
Thank you, President Lagarde. And the next question is for Eshi Nelson of the New York Times. Eshi, please.
Hi, can you hear me okay?
Yes.
Okay, fantastic. Thanks, President Lagarde. Just two quick questions. To what extent was the plan the EU put forward to reduce its dependency on Russian energy considered in the current forecast for inflation? And secondly, on your point about a short time after that wording for raising interest rates, are we supposed to read that as a longer wait than how it was described before, where asset purchase program would end shortly before interest rates would increase?
I would have to double check on your first question, because I'm not aware that the plan to reduce dependency on Russian gas was incorporated as a geopolitical decision or as an energy decision made by the European authorities and with the national leaders of the member states. What I know for sure is that we factored in a significant increase of prices wherever that product comes from. On the, sometime after, I know this seems like great elaboration, and in a way it was. We could have substituted the shortly before by shortly after, but that would have made it too time dependent in terms of decision making. We want to be data dependent. So whenever the data confirms that the medium-term inflation outlook is at target, then the decision should be made. We're guided by our strategy review. We are guided by our forward guidance. We're not guided by a time element that would predicate that within X weeks or within X months, decision will be made. So the deliberate use of some time after opens sufficiently wide an interval of time so that we can review the data, determine the robustness of the data, make sure that some uncertainty has cleared a bit so that we can make a decision. I don't know how I can more explain this sometime after, but that's what our debate was about.
Thank you, President.
And again, if I can just insist on that, we want to have as much optionalities as possible. We recognize that there is huge uncertainty and that things can go in all sorts of directions. And we want to be able to respond to those circumstances. And to do that, we need to have all optionalities on the table. We keep all the options opened, and we will proceed, and we are proceeding step by step.
The next question is for Azahara Sanchez of the Spanish television La Sexta. Azahara, please.
Hi, thank you. Can you hear me?
Yes.
Okay, thank you very much. My question is for Vice President De Guindos. Back in 2012, when you were Spain's economy minister and the Sareb was created, you were in a press conference where the Vice President Soraya Sáenz de Santa Maria said that Sareb would not cost an euro for the taxpayer. And you yourself said that it would minimize the impact that the bank intervention could have in the cost for the taxpayers. Now Sareb's 35 billion euro in debt is officially public debt. Did you fool Spanish people back then? Thank you very much.
Well, what I have to say is that Sareb was part of the package to rescue the Spanish financial system, and it was agreed with the European Commission, with the ECB, with the IMF, and well, Sareb was perhaps the most powerful instrument in order to clean up the balance sheets of the Spanish banks. And I think that is right. It has a debt of 35 billion euros. But as well now, it has assets worth clearly beyond 32 billion euros. So Sareb has been quite a useful instrument that was used as well, and this instrument was used in other countries like Ireland, for instance. And I think that what we have to do is to try to gain time in order to get advantage of the evolution of the real estate in Spain, that now is much more positive, and to reduce as much as possible the level of debt of Sareb.
Thank you, Vice President. This brings to the end our press conference today. Thank you very much for joining. Our next regular press conference is on 14 April, and up until then, best wishes, stay safe. Thank you, bye-bye.
That wraps up a, let's call it messy, news conference in Frankfurt, Germany with ECB President Christine Lagarde. Here's your price action going into the opening bell in New York City a few minutes away. The equity story shaping up as follows. Equity futures in the United States on the S&P 500 negative by a little more than 1%. The euro negative as well. We've been dancing around over the last couple of hours. We'll talk about that a little bit more a little bit later. Euro dollar negative 0.4% to 110.33. The move in the Italian bond market, Germany too, notable. A big move on the Italian 10-year by 21 basis points to 190, just short of that level. On the German 10-year, up around about 6 basis points. The words of President Lagarde, there were many through the last 60 minutes or so, maximum optionalities in the face of maximum uncertainty. Take a listen.
It can be the week after, but it can be months later. And by that, I think we want to indicate that the time horizon is not what is going to matter most. It's the data that will support the decision that is made by the Governing Council.
Guy Johnson with us from Frankfurt, Germany. Guy, some of this needs explaining. So in the statement, this is the language that we've used. Any adjustments to the key ECB rates will take place sometime after the end of the Governing Council's net purchase under the APP and will be gradual, etc., etc. Sometime after can be the week later, but it can be months later. Guy, a lot of people watching that are exhausted now. Make sense of it.
I'm really struggling, John. I have to say, Christine Lagarde may not have a PhD in economics, but she's certainly beginning to speak their language. On the one hand, this, on the other hand, that. That certainly seems to be the narrative coming out of here. She used the word optionality time and time and time again. But clearly, you take a look at the price action, you take a look at that statement, the hawks are much more in charge of this narrative. This is a narrative driven by a continuing upside surprise on inflation. Christine Lagarde talked about the idea that they were not accelerating the exit from extraordinary monetary policy, but certainly judging by the market reaction, and you were bringing up the BTPs just a moment ago, that is the way that the market is reading that. It looks like the hawks are definitely in charge. She's trying to maybe just sort of tamp down expectations a little bit, but nevertheless, optionality is definitely going to be the key word here. The ECB is clearly data dependent. It may not be an acceleration, but certainly I would have thought, judging by the data we've seen thus far, the staff projections that we've been getting, that a 2022 hike is now certainly back as being maybe the base case for the ECB, John.
Guy, you'll have to forgive my frustration in my voice, but following all of this has been pretty tiresome. Futures going into the opening bell, ran about down 45 points. on the S&P, down about 170 on the Nasdaq. Your euro negative 0.4. We've talked about that. Yields up 2 basis points, approaching 2% again at 198. Guy, President Lagarde talked about they weren't in any way accelerating tightening, but you just go through the statement and look at the wind down of QE. The numbers just speak for themselves. Yep. I just wonder what's going on inside the governing council. There was this sort of off-the-cuff remark about you're going to go out there and call people. They're going to say different things about different things. Are we expecting that kind of story immediately after a news conference with the ECB and people coming out and saying this is not what we wanted?
Well, I would be very surprised if we don't get commentary from either fringe, apologise for the ambulance, either fringe of the governing council here. Clearly there were some doves that wanted to be cautious here, but I would say on balance the hawks are now in charge of the governing council. Lagarde is clearly struggling with that. She clearly doesn't have the same touch that Mr. Draghi once did in controlling the narrative. The narrative is controlling her rather than the other way around, and it is clear that the hawks are in charge. The statement said it, the star projections gave you that indication as well, the market reaction is telling you that as well. This is a central bank that is exiting its extraordinary monetary policy at a faster rate than the market anticipated. The market clearly was wrong-footed going into this, John. We are now starting to correct that very quickly. Inflation is the mandate. Inflation is the problem. That's what they've got to focus on right now. The pace, I think, will be determined ultimately, though, by growth.
The Italian bond market speaks to everything you just said. Guy Johnson, thank you. Joining us now, Bowersock's Emily Hill, Pictet's Luca Paolini. Luca, I want to come to you. Was that a dovish news conference or a hawkish one?
Well, I think the message is pretty clear, right? I think there is a tightening of monetary policy here in Europe. At the same time, Christine Lagarde is trying to send a more dovish signal, but the reality is the market, I think, is pretty clear. There is more tightening. In a way, less easy means tightening. And I think it's also pretty clear that the focus now, the top priority, is to fight inflation and not to support growth. So I think that's pretty clear. Now, if the first hike is going to be in September or October, probably doesn't make a big difference. But I think the message is hawkish, and I think the market is reacting because of that.
Well, that's the challenge. They've had to downgrade the growth outlook, upgrade the inflation forecast. And Emily, I wonder if we're about to see the same thing happen in the United States next week at the Federal Reserve. From your perspective, have we downgraded the outlook for global growth for earnings to the extent we need to?
Well, I would say President Lagarde mentioned several times that they were normalizing, not tightening. And I think we're going to hear a similar message coming out of the Fed. They're walking both central banks are walking a very fine line here. And I think, people are worried about stagflation. I think to a certain extent, we already have stagflation. And, both the ECB and the Fed are aware of that. And I think that we're going to hear a normalizing, not tightening message from the Fed as well. And I think we can expect probably fewer interest rate hikes than people were projecting, just 3 or 4 weeks ago.
Looking at the opening bell about 3-4 minutes into this, the S&P 500 down a little more than 1%, top of the pile. We've got used to this story, haven't we? Up 1.6%. The energy names advancing early in the session. Looking at crude right now, Brent and WTI, both of those up by almost 5% on Brent to 116, on WTI up 4% to 113. Just quickly, Luca, that inverse correlation between the euro, weaker again today in the face of this conversation, and Brent higher. How much of a problem is that going to become for the ECB this year? Not sure that Luca Paolini can hear me, so we'll move on to Mike McKee. Mike McKee, you and I can have that conversation another time. Talk to me about CPI in America, Mike. Never mind CPI in Europe and the outlook from this ECB.
Well, there are some similarities because CPI in the United States is showing inflation just as bad here. Well, actually worse in a numerical sense. To get the historical comparison right, since Madame Lagarde said it's all about the war, Leonid Brezhnev was the head of the USSR the last time inflation was this high in the United States. Headline inflation 7.9% on a year-over-year basis, core 6.4%. And that is not good news for a Fed that has to figure out how it's going to handle that while at the same time worrying about what happens with the economy. Here are some of the biggest movers. Apparel was up 0.7, food 1%. Biggest thing was gasoline up 6.6%. And at this point, I have to step back and say, look, this was February, before the war started, basically. So you know we're going to have more inflation in March. We just have to wait and see what happens. Now, the Fed knows that, too. And they also know that some of the things that we had seen go up post-COVID will start to go down. Used cars were off in price. So they're going to be watching this. They're going to be watching inflation expectations to make sure they don't become unmoored. And the problem is, if you look in the lower right-hand corner there, you can see market expectations for prices over the next 5 years for the first time in a while are starting to rise a little more significantly today after seeing this data. And so the Fed has to act. They're going to raise 25, but it doesn't totally take 50 off the table in the meetings after.
Mike, can you talk to me about the inflation outlook at the Fed? Bill Dudley, formerly of the New York Fed, called it Fantasyland a number of months ago on Bloomberg surveillance. The PCE forecast for 22 is 2.7%. Then it drops to 2.3, then to 2.1. Interesting just looking at the ECB outlook for inflation. 5.1%, an upgrade to this year, or a downgrade, depending on which way you look at it, but certainly a lift to the forecast, 5.1 versus 3.2. Then 1.9 in 2024. Mike, what is it about central banks that just keep on saying, we'll get there, we'll get to where we need to get, and they always just pin that into the forecast?
Well, in their defense, and somebody has to defend the Fed once in a while, that forecast was made in the first part of December, and a lot has changed since then. There was no war at that point. So let's give them till next Wednesday when we get the decision and we get the new dot plot and the new forecasts. So we'll see if they raise their inflation forecasts and by how much. The interesting thing is Bloomberg's survey of U.S. forecasters for the month of March just came out, and PCE inflation, which is what the Fed will make a forecast on, is scheduled to be 5.4% now for the year. Will the Fed go that high? They haven't in the past. It's going to be interesting to see if they agree with what market in anticipation of inflation is.
Mike McKee, thank you, sir. One name I want to look at, 7 minutes into the session, Amazon up around about 4%. Certainly not in line with the gains we saw after the close yesterday. I think we were looking for a bigger pop than that. The opening bell, about 8 minutes behind us, we advanced 4 percentage points. A 20-for-1 stock split, a $10 billion buyback. Does the stock split matter? You know my views on that already. But this is what Morgan Stanley had to say, more symbolic than material. And on the symbolism, the analyst community seemed to believe that perhaps this is a tilt to a more investor-friendly stance and away from the big monster capex cycle of years gone by. Perhaps the stock up by a little more than 4%. Emily, I want to come to you on how corporate America deals with the inflation story that Mike McKee just described. Margins were great through 21. Can that story continue through 22?
I think we're going to see significant margin pressure. And one of the the part of the market that I would argue is the most defensive are going to be any companies with significant pricing power and that aren't going to succumb to or not going to be affected as much by higher input costs. So yes, I think margins are inevitably going to be under pressure. You know, we've got high input costs, not just in energy, but in all sorts of commodities that are coming out of Russia. Look at neon gas, neon, which is a critical component in manufacturing semiconductors. So it will reverberate across the economy, and there are going to be very few companies whose margins will be immune to
Emily,
that.
Luca, stand by. We're going to work through the situation in Ukraine in just a moment. The S&P 500 down by a little more than 1%, on the Nasdaq down by 1.6%. This after some monster gains yesterday. The biggest one-day pop on the S&P going back to June 2020. On the Nasdaq 100 back to March 2021. So we come back again, down by 1.6%. Seemingly the story of the morning. No diplomatic breakthrough whatsoever between a meeting between the Ukrainian foreign minister and the Russian foreign minister, just going by the headlines we got from that. And an urgent call from Chancellor Scholz alongside President Macron to President Vladimir Putin of Russia, pleading, demanding for an immediate ceasefire. No breakthrough there either. But what we have seen every single day, day after day, another company joining a long list of companies pulling out of Russia. Abigail Doolittle, the latest on Wall Street, please.
Yes, we did have a breaking headline right around 9:05, and it was based on Bloomberg exclusive reporting. Goldman to exit Russia in Wall Street's first pullout. So in other words, Goldman is exiting its business in Russia. The first big bank to do so, the company saying Goldman Sachs is winding down its business in Russia in compliance with regulatory and licensing requirements. We are focused on supporting our clients across the globe in managing or closing out pre-existing obligations in the market and ensuring the well-being of our people. This means, importantly, John, that the firm is still trading corporate debt tied to the country, but without itself as a principal making bets on price movements. They are a market maker, and they are also helping clients to reduce their risk in Russian securities. Now, Goldman, of course, earlier this year, or this month, I should say, began to move its Moscow-based staff. The question, John, here is, will other banks follow? Citigroup, of course, is assessing its operations. It has the largest presence in Russia of any U.S. bank. Goldman, again, acting as a trailblazer, the first to leave Russia. The stock down a little bit, in line with markets lower today, despite the fact that yields are higher, John.
Abby, thank you. Coming up on the program, Russia and Ukraine making little progress in high-level talks.
We agreed to continue efforts to seek a solution.
That conversation still ahead.
The broad narrative that he conveyed to me is that they will continue their aggression until Ukraine meets their demands. And the list of those demands is a surrender.
Diplomatic talks between Russia and Ukraine delivering no breakthrough. The Russian Foreign Minister Sergei Lavrov sticking to the Kremlin script and saying the following: "We want a Ukraine that's friendly and demilitarized, where there won't be a ban on the Russian language, on Russian culture." Team coverage starts right now on both sides of the Atlantic with Bloomberg's Maria Tadeo and Anne-Marie down at the White House in D.C. Maria, first to you. The talks lined up in Turkey, the foreign ministers from Ukraine and Russia, and seemingly no breakthrough.
Well, there is no breakthrough. And Jonathan, I was watching that press conference of Sergei Lavrov, the Russian foreign minister, and to me, it was like watching a press conference done 2 weeks ago before the war started. He repeated the same talking points we've heard now for months for Russia, that they don't want to attack anyone, that going into Ukraine is a special operation. This is not a war. It was a preventive move. He also said that now in the territories, quote, that Russia has liberated in Ukraine, they have proof that the United States and Ukraine were working on biological weapons. He reiterated Russia has goals to comply in Ukraine. And then, of course, you had the Ukrainian foreign minister, Dmitry Kuleba, saying essentially this was the same old story that we've heard repeatedly. What they want is a surrender from the Ukrainian government, and that is not going to happen. And Jonathan, you have to put your headset and your mind in the perspective of the Ukrainian people. They really feel that this is a war that they can win. There's a huge spirit in the country of continue to fight, and resist. So for the time being, there is nothing that indicates there is a diplomatic breakthrough in sight.
AMH, the pictures that came out of Mariupol yesterday were deeply disturbing, incredibly upsetting, and we're all seeing this play out in real time. There was a conversation in financial markets about so-called peak sanctions. I wonder if the pressure builds even more so, not on the Americans necessarily, but on the Europeans, to push further on this, and perhaps the White House pushes them to do so, given that these pictures, right now at least, are a daily occurrence.
Jonathan, that's exactly right. When you see pictures like we have coming out of the city of Mariupol, when we have bombs on a hospital that had a maternity ward, there is pressure now building to really top heights on this administration and capitals in Europe to inflict more pain on President Putin and those that surround him. We already saw a move very early this morning from the United Kingdom going after 7 individuals close to President Putin. Roman Abramovich is one of them, Igor Sechin, another one. And then also, Jonathan, here at the White House, we had a Bloomberg story yesterday, a scoop that they're also potentially going to sanction one of Russia's, the biggest atomic energy company. So you can see they are looking at other ways to continue the pressure on the Kremlin in hopes of potentially trying to bring these Russian troops back and stop this onslaught on the Ukrainian people.
Anne-Marie, there's a domestic story here, of course, as well, and we need to talk about it. Secretary Granholm yesterday faced down oil producers in America and is pleading with them to produce more. We're at a point now where the US government has to think about incentivizing that, given that the price at the moment isn't a big enough incentive for them.
The price at the moment isn't a big enough, and a big talking point at the White House is the fact that they have these 9,000 unused leases, but clearly these companies are not using them at the moment. So potentially, Jonathan, that is something that they need to think about. How are we going to get domestic producers to want to engage and drill more? Because obviously taking out Russia's economy, and this is a massive commodity producer across the board, you are going to have elevated prices for a while. But Jonathan, we should note the administration is trying to explain this to the American people, and they are using this tactic, and they are blaming this all on President Vladimir Putin and his war on Russia. We have seen very much so prices spiking because of that. But we should note, in August, the administration was talking about the fact that oil prices were higher and were calling on OPEC. So this has been a problem in the administration, in America, in other European countries as well, in consuming countries. They were all going to be dealing with higher oil prices this year.
AMH, thank you. Anne-Marie in DC. Maria Tadeo, just fantastic work over the last few weeks. We appreciate your time as well. Emily Hill, Luca Paolini, back with us. Emily, I want to come to you. You talk about leaning towards high quality value. Is this just about making it not complicated? Keep it simple, maximum uncertainty for the time being at least?
No, we've become much more bearish on 2022. So the reason to be defensive is because, frankly, I think that this geopolitical issue, which we know historically the markets don't react to geopolitical issues, and they in a substantial and prolonged way. But this problem is not going anywhere. We're dealing with a person, and I will confess that I am very surprised that Vladimir Putin made this massive a strategic blunder. I think he underestimated the West. He underestimated democracy, which he's very disdainful of. And I think he knows now that he's made a very substantial mistake and he's backed into a corner. And so I don't see an end point to this. And unfortunately, when we see spiking oil prices, historically, there is a very strong correlation between spiking oil prices and recessions. I think that correlation has broken down a little bit over the last 15 to 20 years. But the reason to stick with high quality companies with pricing power is that's where you're going to protect portfolios.
We are slowly unplugging one of the biggest commodity producers in the world, on the planet. Companies are pulling back. We potentially could face, Luca, a credit event, a default, a sovereign default. At the same time, we're pulling back QE. It's finished at the Federal Reserve. At the ECB, they're looking to wind that down by Q3. I'm looking at Italian 10-year yields at the moment, Luca, up 20 basis points, just short of 190, 186. For European banks, UniCredit down another 6 percentage points, SocGen down by 5.5%. Luca, that was such a consensus view coming into 2022 by the banks, by Europe. Things can change for ECB rates. Luca, what do you do with the European banks now, and how much of a risk is building on the continent?
Well, let me say that the call on European banks was based on the assumption that European growth would be very solid. And when you have, inflation, where it is going to be probably close to 7%, you're going to have obviously the impact on confidence, consumer business confidence from the situation in Ukraine. Well, you have on one side the direct impact of Russia, but also the impact of weaker growth. And banks were actually, as you rightly say, very overbought just a few months ago. I still believe that if there is a resolution in Ukraine and Russia, I think European banks have upside. But at this point in time, the risk is simply too high. And so I think we have been reducing our exposure to financials in general. And obviously for Europe, the situation is even more dangerous. And I think you see the price performance. I think it's it's consistent with the picture that we are seeing. And I think it's difficult to see European banks recovering as long as there is a real risk, not only of a credit event, but also of a recession, I would say. I think it's very difficult to be optimistic in the short term for the sectors.
Oh, the outlook for Europe right now, incredibly difficult, incredibly tough. Luca, great to catch up, sir. Luca Paolini, Emily Hill, thank you to you as well. A difficult outlook right now with your sector price action. Here's Abby.
A difficult day for stock traders, or at least stock bulls, John, because we have the S&P 500 down more than 1%. Not surprisingly, most sectors are lower. Now, what's happening today is a reversal of yesterday and more in line with what we've had for the last several days, weeks. Oil higher, up 2.8%. Energy, the best sector. Then consumer discretionary up fractionally. It had been up higher, more so on that Amazon stock split. The optics of it helping out that stock, but consumer discretionary about flat. You can see tech, though, on bottom. Financials, the second worst. This as Goldman says that it's going to exit its business in Russia, the first bank to do so. Interesting to see that sector down with yields up slightly. As for the year, John, it's all about metals, mining and energy. Those are the top sectors on the year.
Energy flying, crude higher again today. Abby, thank you. Up next, your trading diary. 26 minutes into the session, no diplomatic breakthrough between Ukraine and Russia. Equities back down again by 0.8%. The two industry groups that are in positive territory, energy one for the obvious with Brent and WTI advancing today. Consumer discretionary as well. But Amazon is the story there after that stock split and that $10 billion buyback. That's the price action. Here are your trading diary events. President Biden speaking with President Erdogan of Turkey. EU leaders kicking off a two-day meeting at 11:30 Eastern. The US Treasury selling $20 billion of 30-year notes at 1 p.m. And we hear from the president again later this evening. From New York City, this was the Countdown to the Open.